Bloomberg Audio Studios.
Podcasts, radio, news.
Hello, it's Merryn Somerset Webb here. I am going to start this show with a warning rather than a reminder. Instead of telling you that I will be at the Fringe Festival in Edinburgh once again this year, I am going to tell you that the tickets for our run at the Fringe this year are almost sold out. If you don't get one soon, you will lose your chance. So if you were thinking of joining me and John and a bunch of really great guests for stimulating conversations in Adam Smith's Panmure House from August the 17th to the 20th, you had better get your ticket now. Do that by heading to the main Fringe website and searching for Merryn. Now, back to our regular programming. This week on the show, Alec Cutler joins me. Alec is a portfolio manager with Orbis Investments. I wanted to get him on partly because his performance over the last few years has been fantastic, but also because he has some really good thoughts on subject that John and I find particularly interesting. But first, as always, senior reporter and author of the Money Distilled newsletter, John Stepek, the John I just mentioned, is with me, and we are both in the London studio, which makes a happy change. John, hello.
Hello. Nice to see you in person.
I know, lovely, isn't it? And the sun's out. Well, it's not actually out, but it was out earlier briefly. John, listen, we've talked a lot on this podcast about how much market like stability. They like to know what's going to happen. They like to feel that they have some sense of the next couple of years, right? And so that's one of the reasons why we think that UK equities are a go-go, because there's a little more political stability here. Although we slightly worry that maybe we don't have quite as much political stability as we think. But do you know there's one place around the world where you can look at an upcoming election and know who's going to win?
That's certainly true.
How's that for stability?
There's lots of stability there. It's stability positively coming out of their ears.
Absolutely. So, there's going to be most likely a Trump win in the US. That means that the Trump trade is on.
Yep.
So US markets, the S&P made yet another record high this week. Lots of stuff happening. So if you're looking ahead and you're saying, oh, look, the US, it's so politically stable, what with the Trump win coming, what would you do? What's your Trump trade?
Honestly, my Trump trade is hold gold more than anything else, just because it's about... Well, I'd say...
We hold... John,
yes.
We hold gold when we worry about lack of stability.
This isn't just
different kind
about...
of stability.
This is a different kind of stability. So Trump is a weak dollar guy, and by that I mean it's not just things like the money printing and the probably spending much more money and, kind of continuing America's balance sheet decline. It's also about the fact that he's kind of much more overtly protectionist. I mean, that's not like Biden wasn't. I mean, Biden has really just been a continuation of Trump's policies from 2016. So I don't think we shouldn't overdo this. But obviously Trump talks a much bigger game. He's more emphatic about the kind of protectionist policies that he puts in. And so I think that's your kind of primary reason. And that's probably your biggest difference as well. Because again, at the end of the day, if the Democrats did get in, then it's not as if they're going to suddenly announce austerity and stop spending loads of government money, loads of taxpayers' money. They're unlikely to put taxes back up.
So we've already had a high-spending government. We already have a protectionist government. We already look at it and say this is modern mercantilism.
Yeah.
Mercantilism?
That's the
I'm
one.
not sure I've said that word for a long time. There we go. It's a whole new era. Mercantilism.
Can't believe you should have been practicing for the Adam Smith
I should have
talks.
been. We're
all going to have to do it.
We're going to talk a lot about that kind of thing. So this is probably going to be quite good for the UK equity market. I'm already seeing the Trump trade on there. But it's maybe not so good for other equity markets around the world. So if the US pulls itself in a bit, although actually may be very good for European defence companies.
Yeah, it probably depends. I mean, one of the reasons it's good for the UK is also because you've got an element of the growth trade, or not the growth trade. I think people, this is the problem when you've got various kind of paradigms that you've gone through with all the same stocks being at the top. The kind of Magnificent Seven or whatever number it is now have we associate them with big tech and ultra low interest rates. But they also did well in the last couple of months because everyone was starting to get worried about a US recession again. They were starting to get worried that the Fed wasn't going to cut interest rates. To be fair, this is partly because inflation came in much weaker in the US than was expected at the end of last week. And I think some of that's got mixed up with the Trump trade. And so the federal...
You're muddying the waters. You're changing the narrative.
But sorry, but narratives are there to be changed.
He's pretending investing is complicated.
It's not complicated, but you just need to follow what the Fed's doing rather than what the politicians are doing, probably. But if they cut interest rates, then you no longer have this dash for growth where everyone was kind of scared that there wasn't going to be any growth, so you might as well buy Nvidia because it's the only thing that's growing. Now, if you get interest rate cuts, all of the stuff that's lagged, like the small caps have kind of rocketed back in the last couple of weeks.
Hasn't it? One of the fastest, the fastest ever, and the gap in performance between the big and the small is suddenly one of the biggest ever over such a short period. It's been a really extraordinary sudden turnaround, and you're right, that's Fed, not Trump.
And that's the Fed, and it does help feed into the UK, because obviously the UK is a neglected catch-up trade. And now, I mean, according to one of our colleagues over in the markets room, has been talking to various analysts, and suddenly it's like everyone's, essentially using the excuse of Labour getting in to change their views on the UK and start piling in. And I mean, I'll be stunned if we don't see some net inflows within the next couple of months, because everyone's now talking about it.
I mean, like you, I'm hearing nothing but this chat. Endless chat about how the UK is the place, and UK small caps, UK mid caps, that's where you've got to be. This is the next place, etc. I'm hearing it absolutely non-stop, both inside the UK and outside the UK. But everyone also says kind of waiting for a catalyst. I don't know what more they need.
Oh, well, I think, certainly from the chatter I'm hearing now, the catalyst is been and gone. And now it's one of those ones where people are going to start
picking up the money and putting it in.
I think they're going to start panicking. There's going to be people saying, oh wait, what do you mean you're not in the UK yet? As opposed to, what do you mean you're still in the UK? That untouchable basket case. I mean, the pound went back above $1.30. That's wow.
Yeah, and also there has come a point where all the wealth managers who've been cutting their UK exposure down from 30, 40% down to 4 to 6%, etc., where they're suddenly going, actually, maybe this has gone a bit far. Maybe I should be more in my domestic market, because hang on a tick, maybe all of my clients spend in pounds.
Yeah, having seen the drop in Nvidia and the like over the last few days, there will be people really getting worried, because a lot of them have probably got in at exactly the wrong time as well. I do think we've seen a turning point, and I think, obviously, as soon as people start agreeing with you a bit, you get a bit jumpy as a contrarian. But the thing I've learned over time is that, but you do need to buy and hold for a little bit at least before you start changing your mind again.
As soon as anyone agrees with you. And it's not just the small and the mid cap. Someone was reminding me today, and you've often discussed this, it was before 2015, US large caps and UK large caps, adjusted for sector, by the way, so adjusted for the fact that US has a lot more tech. Take that out of the mix, and the valuations were basically the same. The same. The US was not more expensive than the UK in large caps anyway in 2015. That's whole nuts. Volatility, chaos, Brexit, lots of prime ministers discount has run since then and not before. So there's absolutely no reason, with us being stable and them being stable, that we shouldn't equalise.
Absolutely.
And listeners, I wish you could see John smirking a little over there.
Without wanting to get too political, you are sitting down and saying to voters in the US, you can either vote for Donald Trump or you can vote for a mystery president. So it's actually wild that Trump is only just above Biden in the opinion polls, which also suggests to me that if the Democrats really are serious about not letting Trump get in, then maybe they should get someone else to take over from Biden, because if a mystery president can almost beat Trump, presumably an actual president.
Imagine what a real one could do.
Yeah, exactly. But anyway, that's a bit of free advice to any, people. Not that I care who wins either way.
I'm sure they'll pick it up. I mean, the division, and we're not supposed to talk about politics on this podcast, but I have been speaking to quite a lot of people involved in politics in the US recently, and it is absolutely extraordinary, the divide in the Democrats between the ones who want to pretend that everything's absolutely fine and slightly lose their temper if you hint that it isn't, and the ones who think that by staying on, Biden is destroying democracy.
Yeah,
and that conflict is what makes a Trump presidency look like it might be something stable. I mean, it's mad. It makes the Tories look like they knew what they were doing. And we're not getting into politics. Enough of this. One more thing for the Trump trade, right? Trump loves Bitcoin, right? And so does his new running mate. These people are Bitcoiners. So this battle against Bitcoin that has been underway under Biden might disappear, and everyone who's ever chosen gold over Bitcoin on our podcast, including me, will hugely regret it.
This is possibly true. Then again, if Bitcoin actually finds an actual use as a currency, then it's got to be strong and stable as well. And so, for all kind of liquefying Bitcoin could actually bring down its price.
I apologise for him. Just for a moment there, I was getting the Bitcoiners on side. I was going to get some nice tweets from the Bitcoin people instead of all the by the way, very rude ones you've been sending me. And you ruined
they
it.
are terrible.
It was so rude, honestly. I mean,
Sorry,
as I keep
everyone.
thinking, and I think you sometimes say to them, if you believe it in that much, why do you need me to believe it too?
Yeah, and the thing is, we do. It's not as if we're hardly like rampant
Close-minded.
Bitcoin skeptics. It's we're not deniers. We agree that it has a point to varying, to varying degrees. We agree that there is a use to Bitcoin.
Yeah.
It's just that it's almost impossible, certainly to my mind, to put an actual number
Yeah.
on what that use is.
Yeah.
But that's a totally different thing from, we're not no coiners or never coiners.
No, absolutely not. Definitely not. Well, I have coins.
Yeah, exactly. You've got some.
Yeah, at least I
I've
have
got
some.
some Bitcoin Cash somewhere, whatever that is.
Now look what you've done. Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb, and here is my conversation with Alec Cutler, portfolio manager with Orbis Investments. Alec, hello. Thank you so much for joining us today.
It's great to be here.
No. Now, we haven't talked for a while, actually, you and I, well, not in public anyway. So we've got quite a lot to get through. I want to talk about your portfolio, what you've been doing, all the different successes in the fund in a little while. But before we do that, I would love it if you would just set the scene for us a tiny bit. It seems all change in the US market at the moment. Suddenly we're seeing big tech come off. We're seeing small cap stocks really, really raring to go, and a performance gap between the two that's extremely unusual in terms of its speed and extent. Well, what do you think? What do you see going on in the US market? And is that something that's going to ripple out to the rest of us?
Well, if I was going to talk our book and sprinkle with tons and tons of hope, it would be that valuation matters again.
Uh-huh.
I'm not sure. We'll take it when we can get it, just as we'll take the extreme, valuation gradient that we had between mega cap tech and everything else, and invest it into that. So, we'll just take what the market gives us, but it certainly looks like there may be change in the air, and maybe, Merryn, maybe it's just that everybody's maximally invested in NVIDIA, and we're a far cry from the time when most people couldn't spell or say NVIDIA. So, there's no one left to buy.
And so there may be nothing particular going on here. It's simply that everyone is in. There's no one left. I mean, I was looking at a list of one of the big platforms here, very generously releases every week the most popular buys and most popular sells on the platform. And I noticed that last week, the top 10 was basically funds, mostly passive, but right there, bang in the middle, was NVIDIA as the only single stock in the top 10, the only single stock being bought by this very large and quite well-off group of UK investors. That was it. So they're still buying.
Yeah, and there should be a test where they have to say what NVIDIA actually does. That would be good.
Well, I mean, you're not in a minority, well, I mean, it's a biggish minority of thinking there should be more education before people are allowed to go and punt individual stocks in the UK and possibly in the US as well. But nonetheless, so it shows that there's a little bit of appetite there, but maybe those retail investors are the last ones in, and valuation really does matter again. Okay, so we've got tech coming off, small caps rising, and everywhere that you are looking, you are seeing your favorite investment style getting going, which is value plus momentum, right? You always look for value. You make money when that value gets a little momentum.
Yes, and then we get a brief period of a feeling of elation and satisfaction, and that we know what we're doing, followed by a period of fear because our stocks are getting expensive. So unfortunately for a contrarian, we only have a very small window where we actually feel okay, and we may be in that small window now.
Okay, well, let's talk about, well, not in everything, a small window in a few small things, right? So let's look at how you've been making money over the last couple of years. So you've done your record over 3 years and over 5 years is really pretty extraordinary. And one of the things that you've been holding, well, all the things that a couple of years nobody else would hold, right? Defense, energy, etc. So I remember we talked about defense a good few years ago at the time when nobody would hold defense stocks. They were an ESG no, they couldn't be held in any funds that had an ESG overlay or any kind of social overlay. And then suddenly, obviously, a year or so ago, that all changed, and they've performed extremely well since then. And I think you've had a lot of defense stocks, right?
Yes, and people used to ask when ESG was a thing, are you making money for clients off ESG? And I would say no, but we're going to, because it was puking out so many amazing companies to be able to buy European defense contractors at mid-single-digit multiples when Putin had already invaded Ukraine. That was just absolutely nuts. And, same on the energy transition side, where rainbows and unicorn farts aren't gonna power electricity, and, flicking switches and having light bulbs come on, which isn't a real thing.
We'll come back to the energy transition. I have a feeling you've got quite a lot to say there, but let's stick with defense for the moment. You've done very well out of that. These stocks have gone up a lot, an awful lot. But with a probable Trump presidency coming through, one of the things that people keep talking about as a great Trump trade is European defense stocks. Is there still a lot of room there in that sector, do you think?
I'd start with, they're up 5-6-fold, and we were lucky enough to ride that wave. But the earnings expectations are up 3-4-fold. So, it's not like these things are just going up with no fundamentals backing them. And, absolutely, when the higher Trump gets in the polls, the more positively the European defense names react. And, just bigger picture, he sent a shot across the bow 6-7 years ago now to the Europeans saying, you need to provide for your own defense. And, defense is a very odd industry. You spend on defense, one, to protect yourself, but two, to stimulate your own industry and your own R&D. So the Europeans will spend more on defense begrudgingly, but they're going to spend on European defense contractors. They're not going to buy stuff from Lockheed Martin and Northrop in the U.S. That was the old game where the U.S. says, we're protecting you, now you buy U.S. equipment. So there is a long run here potentially.
Okay. So which names look interesting to you?
We shuffle them around a little bit as they get ahead of themselves. The first names we bought would have been Rheinmetall, which people couldn't spell, and now they can spell it. So we need to trim a little Rheinmetall now that people know that it's got an H in it and 2 L's.
Now, not everybody listening to this podcast is going to know about Rheinmetall, let alone be able to spell it. So tell us a little bit about that.
They make tanks and artillery. The Leopard tank, the famous German tank makers. And it was thought a decade ago, 5 years ago, it was thought that we didn't need tanks anymore. We just had smart things that eliminated people without having to move heavy equipment around.
Satellites with lasers, no need for tanks.
Yeah. Yeah, and lo and behold, we need tanks now. So they are the world's preeminent tank manufacturer. And they're getting a lot of orders. And presumably at this rate, they're going to continue to get a lot of orders. Okay, and what else? Saab, we were very early on in Saab, which now people are starting to figure out is not a car company, but they make everything from fighter jets to anti-tank rockets. So that's one of the wonderful things about defense, if you can call it that, is that when you design a weapon, you also are creating sales for somebody else that designed something to kill that weapon. So Saab has seen a booming business. They're also Europe's number one sub maker. So Saab is a very big defense contractor. Leonardo is one that we've bought more recently. We tried to buy it 4 years ago or so, but we didn't like some of the corporate governance that we found. And since then, they've really turned the corner. One of the things that Maloney has done quite well in Italy is straighten out Leonardo. And we own BAE still in the UK. It is kind of the steady eddy of defense contractors. But more importantly, we've wandered east, where we see a much more reliable Cold War-like environment. Everyone's focused on the Ukraine, but it's really the Pacific Basin that's going to be the hot spot longer term, more reliably. So Hindustan in India is becoming the national champion of India in defense, and Hanwha in Korea similarly is the national champion of Korea. Both of those names are up 500-700%, but again, their earnings expectations are up about the same amount, so they're still cheap. And then the biggest of them all is Mitsubishi Heavy in Japan. So Japan needs to go from 1% of spending, 1% of GDP spending in defense to over 2%, which is a massive doubling of defense spending. Mitsubishi Heavy is the biggest recipient of that.
You said that just back at the beginning of this conversation, before we moved into Hindustan and Hanwha and Mitsubishi, you said that you felt that the real center of the Cold War was going to be in that area. Took us through what you mean by that?
When you have a rising superpower and a waning superpower, if that's indeed what we have, 100% of the time they wind up fighting. And the U.S. is dead set on ensuring that fight, if it takes place, will take place in China's backyard, not in the United States backyard. And China has designs, obviously everyone knows, on Taiwan. They also have designs on the South China Sea, which is where all the oil and gas is. And China desperately needs a secure source of oil and gas, because, if they piss off the rest of the world enough, the various straits will be blockaded, and China will lose access to Russian and Mideast oil. So they need to secure their own supply, and they have none on land. So they need the South China Sea for that. So all the headlines that you're seeing around them duking it out with the Philippines or Vietnam for random islands in the South China Sea, it's all about oil and gas.
Interesting, and so that's where you want to be holding those defense stocks as well. Well, we might as well stick with oil and gas. Now we're there. You've been holding energy stocks for quite a long time. I remember talking to you, 3, 4, 5 years ago, and you were already fairly overweight energy, on the basis that if no one else was going to buy them buy the big energy companies at that price, you would buy them and you would wait. And that again has worked out pretty well, hasn't it?
It has, and that it wasn't as simple as let's buy cheap stuff and wait. We did have a thesis that
I didn't mean to make it sound easy, Alec. I didn't mean that.
Yeah. There's a fine line between being contrarian and just being contrarian. So just being contrary would be buying everything that's cheap. Being contrarian puts a little more value add in it, and the value add then was still pretty simple. It was the platitudes around ESG were just crap. I don't know of a kinder way to say it, but it was a belief that eventually all platitudes run into physics and chemistry and lose. And when the physics and chemistry of electrifying the world turns into reality, and people's electricity bills have gone up, as I know you've experienced in the UK, mm-hmm. then people will get real about what the most efficient energy sources are and what's realistic, what's possible over what time frame. And we're going to have to revert back to at least natural gas being the quote unquote transition fuel if we ever complete a transition. But really more recently, we have shifted that oil and gas heavy exposure into critical energy infrastructure, which I still consider to be energy exposure. Mm-hmm. But it is it's hitting a different part of the value chain, and one that we think is far more defensible from what's going to get spent money on over the next 20 years.
So you're talking about electricity generation, and in particular about the grid.
Yeah, and so I started out in this industry as a utility analyst, as an electric utility analyst, and it's kind of the It's kind of the sector that everyone wants to get away from because it's so boring and doesn't grow. I quite enjoyed it because I guess I was a contrarian, and because no one enjoyed it, I did. But one of the degrees that you get when you graduate from being an electric utility analyst is a degree in understanding how old the grid is and how desperately it needs to be upgraded and modernized. That for me was around 2000, 2001. So the grid was old in 2000, 2001. It's really old now because the regulators refuse every attempt to modernize because it makes the bills for customers more expensive. So we now have a grid in the Western world that was built after World War II that hasn't been upgraded at all.
But I
And it's
suppose
starting to fall apart and fall down.
Yeah, there was a period when that kind of didn't matter, wasn't there? I mean, even when you were a utilities analyst, the demand for electricity, even as populations grew, the demand for electricity was not growing because everything was becoming more efficient. And so energy demand across the West kind of flatlined for a while. So this, until really quite recently, so this wasn't something anyone was much bothered about because you could patch it up and nothing dramatic was happening. It's only with the idea of the energy transition and wanting to decarbonize, etc., that suddenly the state of the grid has become incredibly important because demand for electricity has gone ballistic, and so has demand for connections to the grid. So that's been the change over the last, say, 5-6 years.
Thank God for ESG because it was really kicked off and spurred. That catalyst was ESG. And ESG saying, or the war on carbon or decarbonization or whatever element you want to pick from that, was that we can solve everything with electricity because it's abundant and virtually free, especially if we roll out windmills and solar panels. It can solve all our problems. So all problems got laid onto electricity, that old boring thing that was guaranteed to spit out of your plug. We haven't had, people were paying less and less for electricity over time. This is a wonderful thing. Let's just do more of it. The standard capitalism gets put into play. But what has happened to, where the old electric utility graduate thesis meets investing and making money is that old grid that was built after World War II was pretty good. And it was good in that it was built way past capacity. So those old wires, 50, 60, some of these wires are 70 years old, were never strained to the point where they started sagging and lighting things on fire and snapping because they were only running at 20% capacity. So as you rolled out EVs and you rolled out electrification, that capacity factor started going from 20 to 40 to 60 to 80, and those old power lines couldn't handle it. So that's what we're seeing now is the grids basically and quite literally falling apart. There are companies out there that were invested in that were considered so boring that the Europeans were allowed to consolidate it. The world's crappy capital allocators decided to consolidate the wire and cable business around the world, and now the Europeans are dominant in that now very, very important industry.
This is Siemens Energy, for example.
Well, Prysmian is the Italian company. It's the old Pirelli cable. They've rolled up about 40% market share of ex-China global cable production. So these are the massive high voltage cables, the medium voltage cables that you see going past your neighborhood, and then the lower voltage ones that you see coming down off the poles and and coming to your house. And Nexen in France and NKT in the Netherlands, between them they have 80% of the free world's cable capacity. Siemens is, along with GE and Mitsubishi Heavy, they dominate in gas turbines for electric utilities, steam turbines for nuclear plants, and in the case of Siemens Energy, they dominate around transformers and switches. all incredibly important things if you want a functioning grid, and all things that are now sold out. So remember, this went from being a GDP maybe -1 type growth rate sector to these companies being sold out through 2027, 28.
But they are nonetheless not valued as growth stocks.
No, they are not. Not yet.
So they're still cheap.
They are still cheap, yes. Incredible.
Okay, that's a not yet. Maybe that'll change. Now, one of the extraordinary things about the grid, and I don't know if you have this in the US yet, but we certainly have it here, is when you talked earlier about happy thoughts hitting reality. You know, we have that here in the UK now as the idea of green hits the reality of rebuilding the grid. And we've had a wonderful little incident since the election of a Green MP objecting to pylons going up in his constituency because, you know, they're kind of ugly.
Oh, that's amazing.
I know, so there's endless fun to be had here as we watch not only the old grid being refurbished and replaced, but the major build out of the grid that is required if you want to electrify everything, and that means large parts of the country having grids and pylons put down through them, views being ruined, lots of people having pylons much closer to their houses than maybe they ever had before, etc. And I'm interested to see when the pushback comes and how it comes.
Well, you know that politician can bury them. He can say, let's spend 4 times as much, and you can bury them, which they do in California because of the wildfire risk. And we own a company that does that. So Maztec,
you're fully covered. Fully covered.
We are fully covered because the politicians are not going to want pylons everywhere, and or if there's any kind of fire risk, you have to bury them.
Now, ESG has come to an end, or pretty much come to an end, in that there are plenty of articles around at the moment telling us that people are taking ESG-related names off their funds, that ESG departments are disappearing or at least being merged into real departments. We saw Microsoft making lots of their DEI staff redundant, etc. So a lot of these things that John and I talk about a lot as being luxuries of a low interest rate age, and slowly disappearing, and in fact beginning to disappear quite fast. Goodbye ESG, goodbye DEI in a corporate context. But these have been wonderful things for your industry, for the fund management industry to sell, right? It's been a marvelous sales opportunity. Look, you might not like that fund, but boy, have I got another one for you, and this one's all green. If that's going, what do you think your industry is going to flog next?
Our industry's not covered itself with glory in this regard, and it did the same thing in the late 90s when socially responsible investing came out. Everyone came out with a socially responsible fund and gathered money while they could gather money, and you know, and then cover themselves in, we're doing this for the good of the world. Yeah, right. And then as soon as the money starts flowing out, they change the name again to something else to try and market it. And you know, Orbis, we don't play that game. We've never played that game. We actually refuse to put out all the ESG statements that we were required to put out. We put them out because the regulators required us to, but we called them responsible investing, which is something that we could relate to and say, you know, this is what we've always done. Of course, we're responsible investors, but we're not going to sign off on some platitude-riddled bit of marketing. I don't know what our industry is going to do next. I guess we'll just revert back to selling funds however we can sell them, which is just always the case. Could have done a better job as an industry of saying, hold on, this is not something where you wave a magic wand and stuff happens. We tried.
You did try. You did try. I'm just interested to see what comes next. I'm always so impressed with the fund management industry. I'm impressed by the funds that do well, obviously, but one of the things that impresses me most is the marketing machine the industry creates and how it moves on and on and on and continues to gather assets under new marketing techniques. But we'll talk about this again in a couple of years when it becomes clear what it's going to be. Let's talk about the UK. Now, we've talked about this before, both today and other times, about it being just bizarrely cheap. And you've mentioned that you own BAE and Rolls-Royce, and are interested in both those stocks trading on bizarrely low valuations. And John and I were talking earlier
about how extraordinary it is that it's not just small caps trading at discounts to global small caps. It's our big companies, our really well-run, impressive, globally known companies that until 2015 or so, even if you adjusted for sector, right, took out tech, adjusted for that, in 2015, our big companies, our well-known quality companies, were trading at very similar valuations to US companies. And then come late to 2015, 2016, we got our political discount, let's just call it that, political discount that has lasted some time. And these companies are still, all these years on, trading at bizarre discounts to their peers in the US. And we have this feeling that it's ending. It's over. The turning point has been reached. Or is it a false dawn, or is this really a turning point, do you think? I know you are invested in the UK.
Yeah. So again, and maybe it's more hope than identifiable catalysts. But the most powerful thing in investing is value. So buying something cheap, plus momentum, operating momentum, and price momentum. The operating momentum gets the stocks going, and then the price momentum of the stocks going gets the investors interested. And we have a window in time here when the UK names, in particular the mid caps that anywhere else would be a large cap, and the small caps that anywhere else would be a mid cap because they'd be valued more, are starting to outperform the Magnificent Seven. So people are going to pay attention at some point, and I think maybe it's starting. I haven't been in the UK in a few months, but one of the things I like to do is when bringing these names up amongst groups of investors, to listen to what they say, what their reaction is. And, up until very recently, it was, you're wasting your money on owning these. These are, we don't do companies well. We don't manage companies well. The government doesn't interact with the corporate world well. We're just all screwed up, and don't bother, keep your money in the US. And more recently, it's been, maybe they'll have a little bit of a run, and but still not super excited about them. And a year from now, it may be waving the British flag and talking about how great British industry is. And British industry is great. There are great companies there. So the value is there, not just in the multiple, but also in the way the companies are operated and what they do and what their intellectual property is. And we're just going to sit there and wait and, count this momentum as a catalyst in and of itself, and enjoy the ride a bit. So, we talked about some themes that might be a bit longer in the tooth, like defense, because everyone believes we're back in a Cold War. But the UK equities is really, just at the beginning, because we've had doubles and triples in some of our names, and they're still selling at single-digit earnings multiples, which is crazy.
Are you still holding any of our energy companies, any of our oil companies in particular?
Own Shell. Shell is the largest critical energy infrastructure company in the world. So it's not, people think of it as an oil and gas explorer like the rest of them, but they touch most of the natural gas molecules that move around the world. It's a massive critical energy infrastructure company. Love to be hated, Drax. You and I have talked about Drax for a long, long, long time.
We have, and I've got to say, there's a lot of hate for Drax in the UK. There's a lot of the conversation about what on earth are they doing, chopping down trees in Canada, making them into pellets, which is an energy-intensive process in itself, dragging them across the Atlantic, and then burning them here to make electricity. Can this really be more efficient than just digging up our own coal and burning it? That's the Daily Mail case in a nutshell.
Yeah, and maybe I can create some hate mail from you that isn't just about Bitcoin, but
that would be really great, because I'm bored of my Bitcoin hate mail.
When you're as big a biomass industry as that, certainly somebody can find a tree somewhere that made it into a pelleting mill. It's probably a diseased tree that can't produce lumber and can't produce higher value things. we don't want to do a deep dive into Drax, but I'm happy to. If you want to do a full hour on Drax alone.
I don't want to do a full hour, but I do want you just to tell me where the trees actually come from. And you told me before, and Drax says that it's just, it's bits that wouldn't get used in anything else. These trees are being cut down anywhere. It's the waste wood being made into pellets. That's right.
It is the waste wood being made into pellets. The regulation requires that 80% of the biomass that they use come from waste wood. They're at 99.99. They get their biomass from the lumber yards, paper mills of the Southeast U.S. And this is Georgia, Florida, South Carolina, Alabama, which are all forests that were planted 150 years ago to make paper and to make lumber. These are manufactured forests or timberlands that, in fact, since the advent of pelletization and the extra profits that pelletizing gave to the timberland owners, the timberland in the U.S. has expanded. It is not being cut down and denuded. It's expanding because it's more profitable to produce pine than it is to produce cotton. And cotton is an absolutely nasty product from an environmental standpoint. So you're replacing pelletization has spurred the replacement of a nasty farming product with a very good farming product. In the northwest of Canada, they are, again, that's been a forest, a timberland that's been managed by the Canadian government very well for over 200 years. And I think, if the Brits took a page from the Americans and the Canadians, maybe Britain would still have a forest somewhere.
We do have forests. Well, we have some forests. Come to Scotland, Alec. We have a lot of forests. We have maybe not quite as well managed as your Canadian ones, but we have forests. Anyway, so okay, I've learned a new word, pelletization. So we can probably move on from drags now. Now, listen, there's one other solution that I write about quite a lot, solution to our transition, our decarbonation problem, and that building little nuclear plants all over the place. And, the obvious answer to that would be to invest in uranium. Is that something you look at or are interested in?
The obvious answer might be to invest in uranium, but I think the most profitable investment would be in Rolls-Royce. They've been building small modular reactors since 1952 for the British Navy in the submarines. They've never had an accident. They are really good at it by now. And the UK government just needs to approve their designs and get behind them as a British global champion. Again, everyone is fascinated by whatever project Bill Gates is funding. But here is a proven SMR technology right under British noses that, what if the UK led the way in SMRs for the world and rallied around Rolls-Royce to do that, and in doing so creating an entire ecosystem supply chain that can be in the UK. These are the bits and bobs in a small modular reactor are just the things that the British people do extremely well. Very high tech machine parts, effectively. It's great. Let's do it.
It would be a lot more effective than trying to lead the world in wind and solar, wouldn't it?
Not going to happen. It's that game is done. But SMRs is up for grabs, and I would encourage this new government, to do whatever they can to make a national champion out of a company that's building SMRs, been building SMRs for 75 years.
Yeah, and for that, they don't even have to pour a pile of money in via the new National Wealth Fund. All they have to do is actually approve the designs and be supportive. Say nice things is one of those things when all they have to do is say nice stuff. You don't get that often as a government.
And politicians are really good at saying nice things. Just wish they do it for Rolls-Royce.
Inflation and government debt, and which leads us then on to gold. I know that you are not a huge believer in the idea that we're all done with inflation. We're back to around 2%. That's it. We don't need to talk about this anymore. It's over. I don't think that's how you feel, is it?
Well, I do think that we're going to get inflation at 2%. And this is how. they keep redefining what CPI is, right? Whatever is annoyingly adding to inflation, they just take out of the CPI. So here's my plan for how the Federal Reserve gets to 2% inflation. They just define CPI equals 2. And there we go. You don't have to kick everything out. Just get to the end of the game and define CPI as 2 and fix it there. And then you can tell everyone you're at 2% CPI. Because I think if, all your listeners.
I wish we'd thought of that before.
Yeah. All your listeners would readily understand that the CPI that's being stated on TV and radio is nowhere close to what their own CPI is as they go to market and they pay rent and they pay the utility bills and pay their car insurance. It ain't 4%, and it hasn't averaged 5% over the last 3 years. It's been more like 10, 12% in reality. So as long as we're not dealing in reality with CPI, let's just get done with it, be done with it, and call it 2%. But leaving that aside, we cannot get to 2% inflation in any of the math that we do, and we look at it two ways. One, a very standard way, a monetarist way of looking at it, which basically says if the government's going to print money like crazy, then and spend money like drunken sailors, although sailors now don't drink as much, and so I think we need to change that to spending like drunken politicians, because they seem to be the ones that are good at drinking and spending money. This is absolutely unsustainable. The United States now has a deficit to GDP of nearly 120%. That's completely bonkers. And debt to GDP of 120%. The interest expense is skyrocketing. The interest expense for 2 decades, normalized for CPI, was around $500 billion. It's shooting up. It's on its way to shooting up to almost $2 billion as a run rate for 2025. And to put that in context, because we don't understand trillions anymore. The defense outlay in the U.S., which is the biggest defense spender in the world, is around $800 billion. So it's blown right through defense, and now it's double the cost of spending on defense in the U.S., and it's skyrocketing higher, which is creating a death spiral in debt and interest expense. That is massively inflationary. We can pretend all we want that it's not, which is what we're doing. We're kind of pretending and extending, and it's just getting worse and worse and worse. And if you look at the two political candidates for president, they have a lot in common. They both love spending, and Trump loves cutting taxes. So both of which stimulate the economy short term, but eventually have to be paid off. And they're just the U.S. economy now is addicted to government spending, which, by the way, feeds directly into GDP. So it makes the U.S. look great. The more you spend, the stronger your GDP is. The more people want to send their money from the UK to the S&P 500. But this is unsustainable. We just can't understand a 2% inflation figure out 10, 20 years. That doesn't mean that, Merryn, that we could hit zero inflation next year. Who knows? Base effects, and it's a year over year thing. But if we're running a global balanced fund, we need to think about bonds in the context of their duration. And there's just no way we're going to buy a U.S. Treasury at 4.25%, 10-year Treasury at 4.25% if we think inflation is going to be over 4.25% over the next 10 years. We can't do that for our clients. So that's where we get into something like gold or Treasury inflation protected securities.
Okay, so that brings us to the very last question that I do ask everybody, but I think you've pretty much already answered it. Gold or Bitcoin? We note, by the way, that Trump's new running mate is a Bitcoiner, that he owns Bitcoin, that he's very keen on reducing the regulation around crypto. And of course, Bitcoin has had a nice little bounce this week after a fall the previous weeks, apparently because of the German government selling. But if Bitcoin is a Trump trade, and it's quite popular at the moment, If I ask you, I distracted myself there thinking about Trump and Bitcoin. Back to the core question. Gold or Bitcoin? 10-year period, you're only allowed one of them.
Yeah, it's gold. But I'll give you the reason. Behavior, how something behaves is important. And people can say that that Bitcoin is the new gold, but they don't behave anything alike. And so nor should we expect them to behave anything alike. And what Bitcoin behaves like the NASDAQ. Its correlation to the NASDAQ is quite high. So, I don't think I'd own gold if it was highly correlated to the NASDAQ, because it provides you some diversity in a global balanced portfolio that Bitcoin just could never do.
Alec, thank you. Thank you very much indeed. That was all incredibly interesting and useful. And I'm kind of assuming that all our listeners are now rushing out to buy Rolls Royce and Drax. We'll see. Hate mail to the usual address. Alec, thank you so much for coming in today.
Thank you, Merryn. Great talking to you.
Thanks for listening to this week's Merryn Talks Money. We'll be back next week. In the meantime, if you like our show, rate, review and subscribe wherever you listen to your podcasts. Also be sure to follow me and John on X or Twitter. I am at MerrynSW and John is at John_Stepek. And of course, do sign up for those last few tickets to our show. And keep sending questions or comments to merrynmoney@bloomberg.net. We're collecting personal finance questions to answer when we're back for a new season of Merryn Talks Money in September. So your house price questions, your mortgage questions, your pension questions, your ISA questions, insurance questions, send them all in. And one more thing, for all the people who do not know this but should know this, Bloomberg has a brilliant website with loads of great content, including my columns, for a very, very reasonable rate. If you go to bloomberg.com/subscribe, you can see the latest offers and sign up to read all of our great journalism, including the interview with Donald Trump that was released just this week.